This podcast is brought to you by Customplan Financial Advisors, Inc., an independent insurance managing general agency in Canada. Financialpodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello, and welcome to the Financial Podcast. My name is Gary Poyer. The Financial Podcast is brought to you by Customplan Financial Advisors, an award-winning managing general agency that provides exceptional support and resources to the independent financial advisor. Please visit customplanfinancial.com to see all of the resources that are available to you as an independent financial advisor. Today, we're going to be focusing in on a very important topic for business owners, that being succession planning. And I'm happy to say that we have with us today our guest, Irfanali Moledina from RMI Professional Corporation in Calgary. Now, if Irfanali's name sounds familiar, it is, because Irfanali was our guest way back on June 21st. So Irfanali, welcome back.
Thank you for having me again.
Well, it's a pleasure to have you back. Irfanali, to refresh our memories, why don't you tell us a little bit about yourself and your business?
For sure. So my name is Irfanali Moledina, founding partner here at RMI Professional Corporation. So we're a full service accounting firm dealing with over 1,000 corporate clients in a wide range of industries. We work closely, of course, with a lot of financial planners and other support team members for small business owners. Our specialty is dealing with small to medium-sized companies, and we do everything from bookkeeping work to personal taxes to, of course, corporate taxes, and even review engagements for some of the larger corporations.
Okay, excellent. Well, you sound like just the person we need to talk to today. So
Perfect.
Thank you again for being here. And before we begin, I just want to mention that succession planning is a huge area. And we could probably do a whole series of podcasts on succession planning. So just for our audience sake, we're only touching on the surface of succession planning. We just can't possibly go into any depth. But Irfanali is certainly somebody that business owners and financial planners should speak to. So I just wanted to mention that. So Irfanali, what is succession planning all about?
For sure. So the key with succession planning is really your exit strategy to your business, right? And there's lots of different ways that can happen. I know what happens a lot of times is people get so excited about starting a business or getting involved that they don't even think about what is the end game. And so the sooner you can figure that out, the better you can plan for it. And sometimes it might be as simple as, hey, I'm going to pass this on to my children. Or it might be, I want to sell this business in the future. Or it might be, you know what, I'm just working right now as a consultant, building up a good base of money that I then want to use into retirement. And so knowing what that exit strategy is the key to succession planning.
Okay. So why is it so important, or what is the consequence of not doing succession planning?
For sure. And some of the big things is if you don't do this early enough, and we've seen this with some of our clients, then you end up in a position where you're stuck with very high tax dollars when you want to transition your business. And so we've done it with individuals that will come to us and be like, okay, I want to transfer my business to my son next year. And the son's there all excited to go. And we look at the situation of the company and say, well, yeah, we can do this, but do you realize that it's going to cost you this much in taxes? And that's the biggest piece, is if they start the process early enough, there's ways you can mitigate the taxes, or you can do different strategies that will allow you to build the taxes into how you're going to take out income in the future, and do different pieces like that. So really the key, or that the consequence for not doing this, is really just a bigger tax bill that you could have, or potential issues with even being able to transfer the business over.
Okay. Like, I know as a business owner myself, you do a lot of planning when you first start the business and then throughout the life of the business. But when should a business owner start thinking about succession planning?
I think the best answer to that is before they even open the business. And so give you some examples is I've got a couple other companies, and one of them we've had our exit strategy from before the day we started. And we know that it's a business that we're out there to build, that we're eventually going to sell off. And so all our actions we do in terms of our operations of our business is already focused around that exit strategy. While we're starting to make connections and build our business, we're identifying who we can sell to at the same time. And all of that is only possible because we decided our exit strategy from the get-go. Right. And it doesn't mean it doesn't change necessarily, but today is the day you want to really start deciding what your exit strategy is, because as soon as you know that, then you can start actually building your business towards that point.
Okay. I know that some business owners, when they start out, they create their own business plan and they kind of do everything themselves. Can a business owner look after succession planning, him or herself?
To a certain degree, yes, but I would say to the full scope, it might be more difficult. I think the initial stages of succession planning should be done by them or their team in terms of identifying what is it that we want to do. Are we growing a business to turn it into a job for ourselves? Are we creating a business to generate cash flow for ourselves? Are we growing something that we're going to sell off? And that's what they need to really identify, that foundation. Once they have that foundation, then I really recommend working with somebody like ourselves or other accountants that can then help you take what you want to do and make sure you're structured properly to accomplish it from a tax standpoint. Make sure your plan is set up that whatever you have on paper can actually accomplish what you want to do in terms of your actual goals. Okay.
So obviously the business owner needs to sit down, think about their exit strategy, what their end game is, what their goals are. What other advisors, because obviously an accountant is a big part of succession planning, but what other kinds of advisors should a business owner think about bringing in?
For sure. Right away, one of the big ones is a financial advisor, of course, because they're going to be instrumental in terms of that, taking that strategy as well and saying, okay, if it's to sell the business, this is some of the techniques we can do and plan around. And then once you do sell it, what do we do with that money and capital? And what's the next stage, right? And so a financial advisor is going to be very key. And having a good lawyer on your team will be key too. If your goal is to go down, again, let's say it's selling the business or doing some restructuring, you want to have somebody who has experience in that space. Because a lot of times when we do restructuring work, there's an accounting component, but we work closely with a lawyer that will then do the legal component of it. So having a good lawyer on your team would be very crucial as well.
Okay. Well, that makes sense. Now, business owner can set up his business in different structures. So when it comes to a business owner who operates his business as a sole proprietorship, what does succession planning look like in that case?
For sure. That's a very good point, actually, because what's important to remember is a sole proprietorship is the business is the individual. And so when it comes to succession planning in that space, it becomes really important to get the right structure in place to be able to move it forward. If you wanted to pass the business on to your kids, for example, then maybe you need to look at incorporating and making that structure work. Or if it's something you want to sell off, you can't sell off yourself as an individual. Right. So what is it that you're selling off, and do you have that asset base? It could be a form of goodwill or something to that extent. But running as a sole proprietorship, the succession plan becomes even more crucial because you're probably not set up in the right structure to be able to do any succession planning. A sole proprietor is really good in terms of, hey, I'm an individual, I want to just go do a little bit of this work. That can work. But to actually form a business that you can do succession planning with, you'd really want to look and see if you're set up properly.
Okay. And again, that's where bringing in the proper advisors, an accountant, a lawyer would come into play, and not just try and do it yourself. What about a partnership? What does succession planning look like when there's, say, 2 or 3 partners?
Yeah. And another really good one is when you do have multiple partners, step one is, are you all on the same page? Right. Mm-hmm. And so succession planning for a partnership is very crucial because partner A might be thinking one thing and partner B might be thinking something completely different. And they might even be doing a great job of talking to their own individual advisors about their plans. But the problem is if you're not on the same page with that succession plan, that can become very detrimental to the business in itself. And so step one again becomes making sure you and your team and the partners involved understand each other and are on the same page, and then bringing in the right advisors again to say, okay, if we want a partnership and we want to pass it to our kids, what does that look like? If we want to sell this off, are we set up for the right structure from a taxation standpoint? Because a lot of times that might not be the case in the form of a partnership. And so it's important to identify the strategy, be on the same page, and then again, like you mentioned, bring in the right advisors that can help with it.
Okay, so let's say it's a law firm, there's 3 partners. Is it better for each partner to have their individual set of advisors, or is it better to have a set of advisors for the whole partnership as one?
Yeah, so a lot of times it's good to have everybody with the same advisors or the same advisor because they can really guide the whole team in the same manner. Now, I wouldn't say that's a full, hard, fast set rule because a lot of times too, you might have a firm that has 10 different partners. And at that point, the firm itself should maybe have an advisor, and then you should have your own individual advisor to make sure that that plan that's set forth meets your own guidance in the way you want to go, right? And so I wouldn't say it's a hard and fast rule, but a lot of times a smaller one, especially if you're maybe 2 partners, that you want to be able to work together with one advisor to make sure you're set up properly from a tax standpoint, make sure you can accomplish the goals of both partners, and it's not too complicated with such a big team.
Okay, well, that makes sense. Perfect sense. Okay, so I think most people, when it comes to succession planning, they think about privately held or Canadian controlled private corporations. So with regard to a more traditional Canadian controlled private corporation, what does succession planning look like in that situation?
Yeah, so it's a really good point. Is like if you have a regular CCPC or Canadian controlled private corporation, the big things you want to really start to look at is, are you set up? What's the goal again? And if the goal is to say, okay, we want to sell the business, can you do an asset sale versus a share sale? Will become very important. And the reason that becomes important is if you can do a share sale of your business, you might be able to take advantage of your individual capital gains exemption. So you want to make sure that you've put some thought around that. If it's going to be an asset sale, then what does that look like for the carrying of the company? Like you may want to have a holding company in place, for example. Then when you actually sell the assets of the business, you can still close down that company and still have your money available to you at a tax deferred basis. So it becomes very important again to have that identified. And then more so as well, you got to do a bit more thought around saying, okay, if we are going to sell it or if we're going to pass it to kids or sell it to management, what does that all look like? And do we anticipate a share sale or an asset sale? Because that piece becomes really important.
Okay, is one better than the other? Is a share sale better than an asset sale, or?
It depends, like most answers for accountants. And so I think a share sale is really, it can be very beneficial for the seller because of that capital gains exemption.
Right.
And so for those of you that aren't familiar with it, every individual in Canada has an exemption of around $900,000, and that's going to continue to grow to $1 million. And that means on the sale of privately held corporation shares, you could actually claim the first $1 million or 900 right now would actually come back to you tax-free. And so doing a share sale from an individual owner's perspective can be very beneficial because of that. But a lot of times the buyers might not want a share sale because it could be potentially unreported liabilities could come up in the woodwork or different things because you don't know the full history behind the corporation you're buying. And so a buyer a lot of times might say, well, no, I want to do an asset purchase. And they might even be willing to pay a premium for an asset purchase because of that unknown liabilities that could exist.
Okay, so if you buy the assets, the purchaser doesn't have to worry about liabilities.
Correct. For the
If they
most
buy the
part, yeah.
shares, then they're still open to the liabilities. Can you do a combination of both? Like,
You can, depending on the type of business. So there's some businesses that we're aware of, like one of our clients, for example, bought a franchise. And so part of the franchise was a share purchase of the franchise agreement, but then an asset purchase for some of the franchise stores that were owned by the franchisor at the time.
Okay.
And so something like that can happen. So there are mechanisms in place where you could use both. Again, depending on what the strategy is, the value, that's where it's very important to have that team behind you to be able to look at the holistic approach and kind of say, okay, this is what makes the most sense for both parties.
Okay. It sounds like if you do a combination of both asset and share, it can get very complicated.
Oh, absolutely. Yeah. That does get very complicated. So you want to have a good team working with you to figure out what makes the most sense.
Yeah. So as part of that, like complication or just part of succession planning, what kind of documents are usually involved in a succession plan, and why are they, what is about them that's key?
For sure. So from a corporate perspective, it's first and foremost, your minute book is going to be the guiding force of who owns the company, what's being registered at the registries, what's the share structure look like. So that's instrumental on the corporate end of things. On the personal end of things, there's 3 key documents which lawyers can obviously help you prepare. And the first and foremost, most important, is your will. Your will is going to dictate what happens to your shares in your business or your share of the partnership or anything to that extent. And so that becomes super important to make sure you have that up to date. You want to update it when major life events happen. So sometimes you might have parents pass away, or you might have a new child, or you might get married, or any of those pieces. You want to make sure you're updating your will at that point.
Mm-hmm.
And part of your will, I always tell my clients, make sure the lawyers are preparing what's called your personal directive, which is not really on a succession planning standpoint, but it's more that piece that says who's the person who's responsible to say if they should pull the plug or not, if you're in a coma on the bed. And more importantly, on the financial end of things, is your power of attorney. And that power of attorney piece becomes really important, because if you are in a coma or you're at a point where you're incapacitated in some regards, that's the person that has the financial decision-making ability on your financial assets, including your business accounts and all of that kind of stuff. And so you want to make sure that's in place as well, so there can be a smooth transition as part of your succession planning.
Okay, what happens in the situation where the business owner, and let's say there's a single business owner, a single shareholder, he doesn't have a power of attorney and he becomes incapacitated? Can his spouse or a child take over, or what happens with the business and the employees of the business?
Yeah, it does bring in a very interesting point at that point, and it becomes very dangerous, because if the person's still alive but incapacitated, the will doesn't quite kick in yet. And the will process when somebody passes away is pretty laid out in terms of what the steps are. Mm-hmm. So in this instance, what would happen is you'd hopefully have multiple signing authorities on the account. And so anybody who has signing authority will be able to step in and take charge and continue running the finances and the bank. But if it's one individual and they didn't put, let's say, a finance person as a second signing authority, or their spouse or their child as a second signing authority, it could come to the point where the funds are trapped. And the banks would have to work with the family, I guess, of the individual to kind of dictate what money would flow in and out. And it would become a very stressful and difficult situation.
Yeah, I bet. And again, that just hits home the importance of working with professional advisors, because somebody working with you, for instance, you would point that out to make sure that scenario didn't come about. And
absolutely.
So yeah. Again, do it yourself is okay if you're maybe renovating your bathroom, but when you're talking about it being a business owner, you need to bring in those advisors. Earlier, Irfanali, you mentioned about a management buyout, but what are the common exit strategies when it comes to succession planning?
For sure. So the three that I would pinpoint as being the most common I see is an individual might be doing some consulting work in their business and they're saving up for retirement, and it's a business that might not be able to be sold even, right? Mm-hmm. And so in that instance, it's generating cash to then do some retirement planning around it. Okay. Mm-hmm. The second scenario is more passing it on to a group of people. It could be next of kin, for example, children, or maybe you're selling the business to a management team or to something to that extent. And so especially next to kin, you want to be able to strategize what's the best from a taxation standpoint, but also a control standpoint, because a lot of times somebody might be in their 60s and they want to get their kids more involved. They just don't want to pass on full reins just in case, right? Mm-hmm. So passing on to kids becomes very important in terms of succession planning, but it's a common one we see. Going back to selling then would be another one, and selling can involve selling to the management team, for example. You might be selling to key employees, or you might be just selling the corporation altogether to an outside buyer. And that's another common scenario that we've seen a few times.
Okay. So in a situation where the succession plan is the father is bringing in one of the family members. And I always think, I don't know if you ever watched Dallas way back in the 1980s, J.R. Ewing. I always think of that show, but what are the major challenges that a business owner faces when it comes to passing the business on to a family member?
For sure. So the first one obviously is there's a taxation component. You can't just go and all of a sudden say, okay, I'm stepping away and my son's going to take over all the shares and we're not going to do anything else, because that there are tax implications there. So first and foremost, you got to look at what the tax implications are and the transition time, because there's ways to minimize the tax for sure. It's just, what does that transition piece look like? And then the other one that we see a lot of times too is that element of control. And so you might have an individual who spent 30 years growing their company, and now all of a sudden the son's saying, yeah, I want to step in and take it over. But they're like, well, okay, you might be in a new marriage, or you might not even be married. We don't know what the outcome of like spouses on that end come into play. Mm-hmm. We don't know. You could be in your 20s. We don't know what your lifestyle is. Are you going to stay in the country? Are you planning on moving? Like, there could be a lot of unknowns for the child or the individual coming into that role. And so that element of control becomes very important. And what's nice is if the succession plan strategy is laid out in advance, there is options where the individual who owns the business can still maintain control while building up equity or shares for their next of kin. And so again, I go back to saying, like, you got to start that plan in advance to make sure that you can take advantage of the best routes that are available to you.
Yeah, for sure. Is there a strategy, or I'm not sure what to call it, but something that a business owner can follow, like instructions almost, when it comes to succession planning, in determining which family member is the most appropriate or qualified to take over?
Yeah, I think if there was a good instruction manual, I think it'd be a very popular book, that's for sure. But I think the best strategy comes down to what we've done a lot with our clients is actually have meetings with the entire family, right? And that's where it first comes in, because what I've seen, and it's in my own experience, even with some clients, I've seen it where they're like, okay, child number A is going to take over the business. And then we sit down and have the meeting, and the child A is like, well, no, I don't really want this business. So it becomes very interesting from that element. I've seen it where the parents want to pass the business over, and the kids come in and all of them say they don't want the business. And so with one of our clients that happened, and we ended up having to go 360 and saying, okay, well, we're not passing this business off. Let's look at how we can sell this business and how do we position it to actually be sold. And that was another 3 years of that transition plan that we had to implement to make sure the business was more sellable and get the maximum value. So I think when it comes to passing it to family, first and foremost, it's who's actually interested in taking on that next step. And then from there, what's the consequences for everybody else, and how does the whole family dynamic come into play, right?
Yeah. Well, it sounds like, as in life, communication is very important because, I mean, the parents or the owner can't be making any assumptions about what his children are doing. And then I guess the children can't make any assumptions about what the parents are going to be doing with the business either.
Absolutely. And what's nice is there are ways too. What we've seen happen too is son A is going to take over the business, but son B will be gifted or will be provided a dividend of X amount per year, or child C also gets shares in the business, but it's going to be run by somebody else. So there are a lot of different avenues that you can go about, which is really nice. But again, that communication piece is going to be key. Who wants to be involved? Who doesn't? What does that look like for the business, right?
Yeah, absolutely. I read somewhere that intergenerational transfers account for about 60% of successions, and that 90% of these transfers fail. Why do you think the failure rate is so high?
Yeah, it's really interesting. And I think with any business that what I've seen is business owners that go and acquire a new business will really spend the time to research what's the core values of that business, what's the way the team works, what's the way they act, what's the foundation of the business, and can I integrate that into what we're doing currently. And so when it happens to go from father to child or mother to child or whatever the case is, I think that's always overlooked. And the management styles can be very different. And so when a father is maybe more aggressive in some elements and a child won't be, or vice versa, that can end up impacting the business in a negative manner, because all of a sudden the clients might start dropping because they're not comfortable dealing with the other person, or one person might be more attentive to details that then end up getting dropped along the line. So I think that the failure rate is really high because the planning is not done in advance. The training is not done in advance. A lot of times it's just saying, okay, you're thrown into this and you figure it out. And a lot of times they don't have that same skill set that the experience of the parent is actually being there, and they lose that value then in the business.
Yeah, I can see that, definitely. So what about a management buyout? Can you explain the concept and how it works?
For sure. So this goes back to what I was saying is one of the options is you can always sell to your team, right? And a lot of times it'll be management or higher, because those are the ones who are there long-term, who've stuck it out and who've been involved with the growth phase. Mm-hmm. And what's really nice is there are lots of different options available in terms of having management buyout shares. So you can do a traditional share sale to them. And of course, like I had mentioned, share sales can be more advantageous for the seller. So it's a good way to be able to say, okay, we're going to do a share sale to management. Management can get extra bonuses every year that will go towards the purchase. Sometimes you're even able to give options of shares or shares to management when the tax implications come in down the road. So there's a deferred tax component there too. So I think when management is interested and can step in to acquire shares, then that's an option that is readily available. What becomes really key is that really identifying who's stepping into that role that the owner was originally fulfilling, right? Because there's a big component there that you want somebody to step up, and who's going to be the president, who gets to make the decision making, and what does that process and steps look like?
Yeah, I guess one of the advantages of a management buyout is the managers would be aware of any potential liabilities that the company would be maybe exposed to. But again, succession planning it sounds like it can be very complicated, and it's something that takes a long time, lots of communication, and like I said earlier, just the importance of bringing in the proper advisors like yourself and the legal team.
Absolutely.
What about in a situation where the business is being sold outright to a third party? What are the challenges involved in that situation?
For sure. That is a very interesting one, because we see a lot of times good businesses will get scooped up really fast. but bad businesses might linger for a while. So it's how do you really position your business to be sold? And that's the work that needs to be done in advance of that. Mm-hmm. And once you are ready to sell the business, do you have the right information that the seller is going to be or the buyer is going to be wanting, right? And a lot of time I've had clients say, okay, I'm looking at buying this business. Can you do the due diligence on it? And we say, yeah, of course we can assist in that. Let's get these documents from the seller. And it's sometimes days, weeks, months even to get the documents, right? And so in that instance, the data that we're reviewing really comes into question because it's like, okay, you got a set of financials, but it took you 4 months to get them to me. Are you manipulating the data here? Were you really not organized? How have you been running the business? And so by not doing the right steps up front, you can really devalue your business. And that's why when you're selling to a third party, it becomes really important as a seller. The onus is on you to position your business to be sold if you want to maximize the value. And to do that, you have to have your ducks in a row in advance of the sale for sure.
Yeah, I bet. I can imagine selling a business can take a long time. At what point should the process begin? Like if I'm a business owner and I'm thinking I'm going to sell my business, should 5 years or 5 years before I do that, should I start getting the company ready, or 3 years, or when should the process start?
For sure. The sooner the better. Again, like even if you know, okay, this is my exit strategy and it's going to be 8 to 10 years down the road, great. We can plan around that. I would say 3 to 5 years is a bare minimum. And the reason for that is some of the tax strategies that come into play could take a few years to really get to the point where they work for you. And so 3 to 5 years, I'd almost say is a bare minimum that you need to be ready for it. But what's really good practice too, I've seen is you almost have a succession plan or a sale plan in place from day one, where you have a binder that has the history, like all your major documents, where you have insurance policies, you got your financial statements, you have any major contracts, and you have that in a readily available binder that when a seller walks in and says, yeah, I'm interested in buying, it's one binder you pass off and all the information's there. And it takes very little time to actually update and prepare because you've already been doing this from the get-go.
Right. Okay. Well, in that case, it's just being really organized. Because you never know. I guess somebody might walk in off the street, make you an offer. And so I guess the unpredictability of life. So how does a business owner value his business, or what is the process of valuing a thriving business, for instance?
Yes, it's very interesting in terms of value. I do get that question a lot. And the general rule of thumb in 80% of cases, I'd say, is your business is worth 2 to 5 times EBITDA, which is your earnings before interest, taxes, depreciation, amortization. And it's a very general rule because a lot of different factors come into play. Is it a public company? Are you being bought out by a public company? Who are you selling to at the end of the day? What are they looking for? Is it hands off? Does the management have to be heavily involved? Is it purely online with reoccurring revenue? So a lot of these factors come into play in terms of your multiples. We see like product-based businesses that are selling purely online to reoccurring customers. Like those ones can have multiples of like multiple times your revenue, for instance. Or you might see specific industry stuff. And I know that happens a lot in financial advisor world and in accounting world, where it's just a multiple of your client base and the volume that they're generating. So it's hard to pinpoint the exact value piece. To get a good gauge, you want to hire a good valuator that can value the business. Or you work with a good realtor when selling. The other big piece of it that comes a lot into the value is what's the growth look like. A business that's been very steady and not growing wouldn't be as worth as much as a business that's grown 20, 30% every single year for the last 5 years. And so it all comes down to how do you position to maximize that value.
Okay, well, that makes sense. So let's say that I have a thriving business. I call a business evaluator to come in, gives me a value. What's the next step then? Do I just put a for sale sign up on the window, or Or how do I find potential buyers?
Yeah, that's a good point. And again, it's going back to the sooner you know you're going to do this, you can start to identify and engaging potential buyers from the get-go, right? And so it's very interesting when you go with the mindset and okay, I'm selling my business, then you can start to look and say, who would my business be a good fit for and why? And once you can identify that, that's how you can maximize the value. Now, all things short of that, without having those connections and stuff, you can hire a really good business broker, or sometimes realtors will work in that commercial space as well. And they can come in, and that's their role then, is to really find who is that buyer that your business makes the most sense for. Okay.
And I suppose competitors are probably the first place that maybe you'll look. A competitor might buy my business.
Or even somebody who is looking to get into the space, or like do some more like vertical integration in their business. A good example, for example, if you've got a lawn care business, or you might go and sell to somebody who only does snow care because they have no revenue in summer, or vice versa, right? So it could be something that you can find as a good add-on to somebody else's business. And then what they can do is now take both businesses, have a combined clientele, and they can sell their snow removal services to the lawn care customers and vice versa. And now they're buying your business, but adding value right off the bat too.
Yeah, right. Oh, that's an excellent example. What about the possible financing arrangements? So let's say that I'm wanting to buy your business, but I don't have the money. I don't have the cash. How can I get the financing to buy your business?
For sure. So banks will do lending on businesses, and they'll base it on the strength of the company. So a good business should be able to get a lot of financing from the banks. Not likely to get 100% by any means. So you might still have to come up with some capital. But the other techniques that you can use is you can get private investors who can invest in the company. We had a client who did that, had a couple investors help get the business. They've managed it, they've grown it, and now they're buying out their investors because they've continued to grow it and they've got the capital to do that. Another good example of using other people's money would be doing vendor takebacks, or paying out the seller over a few years. And sometimes this strategy could actually be beneficial for the seller too, from a taxation standpoint. So it might be where, okay, you're buying a business, let's say it's for $1 million, that you might pay them $200,000 a year. And now what you're doing is you can use the business's profits and really pay them out over that period of time as well, to limit how much capital you actually need up front.
Right. Okay. That makes sense. What about, you mentioned vendor take back. What are the advantages and disadvantages of a vendor take back? So I've heard there's some risk involved in doing that.
For sure. Yeah. So on the seller standpoint, when you have a vendor take back, the biggest risk factor, of course, is that the new owner is going to be able to run the business successfully. First and foremost, if they can't run it and your vendor take backs to the company, if they run it into the ground in 3 years and you're not getting your money out of it at the end of the day, and it's not your fault and you have no control over it. So you really want to be comfortable with who's stepping in. But some of the advantages to it is you can defer some of your taxes depending on how the arrangement's set up. So that can become advantageous. You may still be involved in the business. There might be what we've seen is saying, okay, there's a 2-year contract that the seller is going to still be involved in the business. So having a vendor take back tied to that length of service is not always a bad thing either from the buyer's perspective, because then they're making sure that agreement's clear on both sides.
Right. Okay. That makes sense. Now, you often hear about an estate freeze. Can you explain what an estate freeze is and how it would be applicable to succession planning?
For sure. It's something we do quite regularly with new clients that come to us. And what happens is you freeze the value of the company at that certain date, and then you can use preferred shares as a technique to restructure. Because CRA's standpoint is anytime you're going to change the structure of a company, it needs to be done at fair market value. Now, of course, if you've been running a successful business, you might own it as an individual basis, and it might be worth $1 million. Well, if you go sell that, let's say, to a family trust, well, all of a sudden, that's going to be a taxable impact to you of $1 million capital gain to your personal taxes. And so, to avoid that, what we do is we'll do like an estate freeze, where you freeze that value of the company at $1 million. And then you can restructure it and issue $1 million of preferred shares to the individual. And then what happens is now you can restructure, put a trust in, put a holding company in, add other family members as shareholders, and those preferred shares can be taken out over time. So what it does is it allows you to basically defer the taxes on the value that you've grown the business to a point where you can take that value over time instead of taking it all in one big hit and taking a big tax hit at that time.
Okay, so there's tax advantages, and then there's also the transfer of ownership.
Exactly.
Okay.
You got it, yeah.
Sounds pretty good. And is there any, this is kind of a hard question for you to answer because it's speculation, but with the amount of debt that the federal government, provincial governments have taken on, is there any danger that an estate freeze may become less attractive in the future?
Yeah, it's always interesting. I think the concept of an estate freeze in general wouldn't be less attractive, but components of how you restructure could be. And I would say as new rules come in, tax professionals are always working to find what makes sense in the rules that are there today. And what's typically nice as well is the federal government won't really go back and change things that have happened in the past. And so if you're to go and implement a structure that works today, the chances are that structure is going to still survive any tax changes for the most part, or still be beneficial from that standpoint. There could be components that maybe it's not as beneficial, but I can't see the structure being detrimental to new rules that would come into play. And so the key is, as a tax professional, we always go with saying, these are the rules we're playing by today. What's the best structure that makes sense? And then if things do change, you may have to revisit that structure and do something creative at that time before the new rules kick in, or once they do, and then move forward from there.
Yeah, because I was just thinking, earlier you mentioned, the time to do succession planning is, right at the beginning. And so, you can kind of project out into the future. I'm going to sell a business in 15, 20, 25 years, but you have to pay attention to what's going on, right? Or have a set of good advisors to keep you up to date, both the legal aspect and the tax aspect. So
absolutely, for sure.
Okay. And you touched on this a little bit earlier about the capital gains exemption. Can you just review how it works again?
For sure. So what exists today is for an individual, not a company or anything else, but every individual has right now around $900,000 that of a capital gains exemption that they can use for the sale of farmland, for example, or for the sale of private corporation shares. And that $900,000 would come in tax-free on any of those sales. And what's nice is if it's like you and a spouse, or you might have you, spouse, and a couple kids, that exemption can get multiplied if you got the right structures in place. Oh. So you could go in and sell the shares of a private corporation for quite a significant amount of money without actually having any tax complications attached to it. So it is a really nice vehicle that's there today. Will it be there in 20 years? We don't know. Will it be there in 5 years? We don't know. But the fact that it is there in existence today is a really good advantage for small business owners looking to sell the shares of their business. Mm-hmm. And there is some benefits again on like farmland specifically and things like that the same rules apply to.
Yeah. Okay. Excellent. Well, hopefully there's no major changes in the coming future, because it would, to me, it sounds like it would be a detriment to people going into business for themselves. Right? Correct, that's one of the advantages of it, and it helps offset the risk of being a business owner. In my opinion.
Absolutely, I completely agree.
Okay, but you know what, Irfanali, it looks like we're just about out of time. I want to thank you again for being our guest and for providing such great value and insight. It's very much appreciated. Irfanali, how can our audience get in touch with you?
For sure. So you can find us online at accountantscalgary.com, or you can just search for RMI Professional Corporation, and you can reach us by phone at 403-457-4232. Easy to get a hold of.
Okay, excellent. And I want to thank our sponsor once more, Customplan Financial Advisors. Customplan Financial Advisors is an award-winning MGA providing exceptional support and resources to the independent financial advisor. Please visit their website at customplanfinancial.com. This podcast is available on Spotify, YouTube, and at financialpodcast.ca. To be notified directly when new podcasts are available, please subscribe by visiting financialpodcast.ca. If you have an idea or a topic for our podcast, or if you know of someone that you think I should interview, please send me an email at info@financialpodcast.ca. We'd also love to receive your feedback. Thank you again, Irfanali, and to everyone else, have a fabulous day.
The views expressed here are those of the participants and not those of Customplan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.